So I'm going to spend a short session now going through various pension issues, and it does seem to be one of those areas that every year becomes more and more complicated. I'm going to be talking through employer superannuation and changes that have happened to that, partner superannuation certificates, salaried GPs and their type 2 superannuation certificates, the McLeod judgment, and finally I'll be looking at pensions annual allowance issues. So starting with employer superannuation, now this has changed a number of times over the years. With the rates initially when I first got involved with GPs being 7%, that then increased to 14% in 2004 when the new GP contract first came in. And at that time, that jump was apparently matched by an uplift in GP income at the same time within the contract. There was then a further change in 2015 when the rate increased to 14.3%, so just a small rise in 2015. And the reason that that rise happened was because there had been a review of the funding of the NHS pension scheme, and it was deemed that there needed to be higher contributions going into the scheme in order to pay out the members who were already drawing their pensions. There was then a further small increase in 2017, which was to add on an administrative charge, which was the 0.08% added on. So that increased the rate in 2017 to 14.38%. There was then a further increase in 2019, which brings us to the position we have now, when the rate was increased to 20.68%. And again, that was a further change brought in order to meet any shortfall in the funding for the pension scheme. Now, it's important to remember that any of the changes in the rates, whether they're employer or employee rates, have absolutely no impact on the final pensions that will be payable to the pension members. And that's because the pensions payable at retirement are based on pensionable pay and don't take into account anything that's paid in terms of contributions. Now, some of you may not recognise the figure of 20.68% as being the charge that goes through your practice, either for the partners or for the employees. And that's because actually practices have continued to pay the rate of 14.38%. Now, the additional 6.3% is still being met behind the scenes by the Department of Health. So the charge still being actually put through in terms of cash for staff and partners is still 14.38%. I think originally when the rate was increased in 2019, there was an expectation that the additional 6.3% would actually be passed on to practices at some point, with additional funding given to those practices to cover the increased costs. That hasn't happened to date, and the position will remain as it is for at least 21-22. What will happen in future years, it's difficult to know, but one would hope that if the additional costs are passed on to the practice, that they will be given some uplifting funding to help towards those costs. But I guess on that one, we will just have to wait and see. That deals with employer superannuation. I just then thought it might be useful to have a bit of a recap regarding year-end pension certificate adjustments for partners, and that's particularly topical at the moment as we're seeing those coming through on the practices GMS and PMS and APMS statements. So the latest type 1 superannuation certificates, which would have been completed for the partners, were the 1920 superannuation certificates, and that covered the period ending 31st of March 2020 and would relate to any accounts the practice had ending in that period. So it might be that your practice has a June 2019 year end or a March 2020 year end, and those periods would both be caught within the 1920 superannuation certificates. Those certificates were due to be submitted to PCSE by the end of February, and the intention from PCSE was that they would process those certificates and put through any adjustments arising from the certificates on your PMS, GMS or APMS statements in April 2021. I have seen some adjustments coming through already on practice certificates for March or April, but similarly, I have seen practices statements for those periods with no adjustments at all. So it's really important that practices look at their statements over the next couple of months, just to double check if there have been pension certificate adjustments going through, and if so, whether they have actually been made at the appropriate rates. If the adjustments haven't been raised, I would suggest that all practices submit an inquiry to PCSE, probably in May, once you've had sight of your open exeter statement for that period. If you do need to go down the route of submitting an inquiry with PCSE, it's always useful to quote the case reference number, which you would have been given when the superannuation certificates were submitted originally. So that's a reference number that comes back from PCSE on an email, normally starting with the letter CAS. Now, it's important that those pension certificate adjustments are processed and processed on time for a number of reasons. So a delay in processing them means that if there is a balancing payment to make, there may be a delay in the tax relief being available for the partners. And that's because the partners are only eligible for tax relief when the amounts have physically been paid. The lack of an adjustment may mean that there's a query on a pension certificate which is holding it up. So it's useful to ascertain whether that's the case, and we can then try and resolve that query. I have to say PCSE do seem to be getting a bit better at sending things back if there are inquiries, rather than the position in previous years where they just seem to put certificates to one side if the figures didn't agree to their records. A delay in processing the pension certificates also mean that there's a delay in processing and updating an individual member's pension record. So if a GP wants to look at what their pension is likely to be, then that won't be updated to 2019-20 until the certificates have been processed. I'm going to talk a little bit later about annual allowances, but that also causes a problem if the pension certificate isn't processed, because NHS pension need the latest pension certificates in order to calculate whether an annual allowance charge arises. And there are quite strict deadlines in terms of requesting the pension scheme to pay an annual allowance charge. So ideally, we want the pension certificates to be processed as soon as possible. It can also cause a problem with trying to finalise a position for partners that have left a practice. Normally, if there is a partner leaving, when we prepare the accounts, we advise the practice to hold some money back to cover outstanding superannuation liabilities. And we will then reconcile that once the adjustment has been processed. So obviously, any delay in that adjustment will cause a delay in being able to pay out to that ex-partner. And if the partner wants to actually draw their pension, there may be a delay in actually getting the accurate figures for their pension if the superannuation certificate has not been processed. Normally, NHS pension will put estimate figures through, resulting in an adjustment at some point in the future. But obviously, if they've got the accurate figures, that's better than having estimates in there. So that's just a recap on where we are with regard to year-end pension certificates. I'm now going to spend a little bit of time going through pensionable pay for salaried GPs. And I have to say that this is an area that we do get lots of queries on because it is quite complicated and quite difficult to understand. One of the key things that needs to be done regarding salaried GPs is that you should be including them on the estimate of pensionable pay form. That needs to be produced each year and submitted to PCSE by the end of February. That form will then drive the deductions from the open exeter statement for April onwards. So it's important that that form is submitted. But please don't just submit that form and then forget about it. If there are any changes in the salaried GPs or their rates of pay and the number of sessions that they're doing, you should then submit an amended form later in the year to try and reflect that. If you do that and PCSE process the form correctly, that will then mean that the open exeter deductions that are being taken are kept on track and hopefully avoid any large balancing payments or balancing refunds at a later date. So just as a recap, if you have a salary GP joining you, leaving you, or changing their sessions or increasing their rates of pay, you should update the estimate of superannuable pay form accordingly. We quite often see problems where GPs move from being a salary GP to a partner or the other way around, or where there are new GPs joining practice where pension contributions are not updated properly. Sometimes that can happen because the performers list hasn't been updated. So it's very important as well that when there are changes to partners or salaried GPs, that you do make sure the performers list is updated accordingly. That should then hopefully enable the estimate of superannuable pay form to be processed. Now you should see, once the estimate of superannuable pay form is processed, that drives the monthly deductions taken from your open exeter statement. Now those deductions will be based on the information from the estimate of pensionable pay form, and it's important when completing that form that you do include details of any pensionable pay the salaried GPs have outside of your practice. That's important to make sure that the right amount of employee contributions are deducted at the correct rate. You don't need to include on the form any hospital appointments, but you will need to include any other salaried GP posts or anything else which is pensionable within the practitioner scheme, such as out of hours payments or appraisal income. As another part of the salary GPs, you should be deducting on their pay slips, employee contributions, and of course added years contributions if applicable. You shouldn't, however, be paying across any employee or employer contributions for the salary GPs with your normal staff pension contributions. And that's because the deductions from Open Exeter are being made instead. If you did pay across the salary GP contributions with the other staff pension contributions, effectively you would be paying the amounts twice. And don't worry too much if the deductions from Open Exeter don't match with the items going through the payroll. Ideally, we want them to be as close as possible, but please don't go through and amend any deductions from the payroll to match what's happening on the Open Exeter system. The deductions for the employee on the payroll should match their gross pensionable pay at the appropriate employee tier rate. All salary GPs need to complete Type 2 pension forms each year. And as is the case for the partners, these need to be submitted to PCSE by the end of February each year. For the 1920 certificate, which was the latest one that was required, the deadline for submitting that was the end of February 2021, and that would cover the salary GP's earnings for the year to 31st March 2020. They should include on that form the pensionable pay from your individual practice, but also pensionable pay from any other sources similar to the position as would have been entered on the estimate of pensionable pay form. This is a requirement for retainer GPs as well as salary GPs, providing they're actually within the pension scheme and contributing to the NHS pension scheme. If salary GPs have missed Type 2 forms from earlier years, there are amnesty forms available on the NHS pensions website, and it is important that they submit the forms for all years when they have been a salary GP. So if there are any years that are missed, it is important that they go back and submit those again. The difficulty with pensions is that they cannot add on the latest year's worth of pension contributions if there are years missing from earlier. So we do get the position sometimes where GPs ask us to help them with this, and we're going back to maybe 13, 14 because they haven't submitted any forms. Obviously, the longer the gap between getting paid and submitting the form, then the more difficult it is to try and ascertain the information, and it may be by that stage that the salary GP has disposed of their pay slips. The main purpose of the Type 2 superannuation certificate is to accumulate all of the income that the individual has been paid that is pensionable within the practitioner scheme and ascertain whether they've paid employee contributions at the correct rate. And that rate will be based on their total pensionable pay. Within the form, they need to include their gross pensionable pay per the practice and multiply it by the employee tier rate that applies to the whole of their income. If the actual employee superannuation, which was deducted from their payslip, is different to this, that will result in a refund or a balance payable. And that amount will be a liability or a refund due to the individual employee. The difficulty then comes when PCSE adjusts for any amendments or any balancing adjustments on the Open Exeter system. And it becomes quite difficult to unravel this at times because those adjustments are normally a combination of two things. So there will be a reconciliation of the deductions made from the Open Exeter statements compared to the pension contributions charged through the payroll. And if there is a difference between those two amounts, then there will be a balance or a refund due to the practice. There will then be a balance or refund regarding the individual salary GP if they haven't paid superannuation at the correct employee tier rate, and that comes from the Type 2 superannuation certificate. Unfortunately, when the adjustment is put through on the Open Exeter statement, those two separate calculations are often combined and shown as one adjustment split between employee and employer contributions for a particular year. It's really important that that adjustment is split out between the practice liability and the salary GP's liability. If there is a liability or a refund regarding the individual salary GP, that should normally tie in with what's shown on their Type 2 superannuation certificate. So it's quite a good idea to ask the salary GPs to give you copies of their certificates so that you can try and map through and match up what's actually happened. As part of the preparation of the accounts for our clients, Lentils will always perform a reconciliation looking at the contributions due from the payroll with the deductions that have been made from the Open Exeter statement. So we will have that information on our file. And if practices are able to provide us with the Type 2 superannuation certificates for their salary GPs, we can normally go through and work out the split between the adjustments. If there is a balance payable, because the salary GP has underpaid their superannuation, then you should put that through on the payroll as an additional superannuation contribution, which is eligible for tax relief. If the employee is no longer with you, you should contact them and ask them to repay that amount to the practice. If there is a refund due to the employee because they have paid too much in terms of employee superannuation, then that should be paid across to the employee as additional gross pay, which is taxable. Obviously, if they have left the practice, you should contact them and make a separate payment directly to them of the gross amount. It needs to be remembered that it is the responsibility of the salary GP to submit the Type 2 superannuation certificates. It is not the responsibility of the practice to do this on their behalf. However, you may want to encourage your salary GPs to submit the superannuation certificates, because any balance payable or due back to the practice will not be processed by PCSE until the Type 2 superannuation certificate is received. You also need to remember that you may be charged with superannuation adjustments for salary GPs that have left the practice. And occasionally we see practices that have merged with another practice or taken them over, and there will be salary GP adjustments going back several years for staff that they knew nothing about. So it is something that you regularly need to keep an eye on when you're checking your Open Exeter statements. If there's an adjustment on there for an employee you do not recognise, or an adjustment that you do not think is correct, we are happy for our clients to contact us or to contact PCSE to try and ascertain what's going on. We do have a help sheet for Type 2 superannuation certificates. So for any of our clients that want to pass this on to salary GPs, we're more than happy to give that information to them. If they just contact their normal manager or director at Lentils, that can be sent through. So that's looking at salary GPs. I'm now going to spend a couple of minutes talking about the MacLeod judgment. Now, this name may not be familiar to you, but you've probably heard of the public sector pension review and the case that came through the court regarding this. So this was the MacLeod case, and it was started by investigations into the fire service pension scheme, which was run on a similar basis to the NHS pension scheme. The background applicable to the NHS scheme is that in 2015, there was a new 2015 NHS pension scheme. And all members who were paying into the scheme on 31st March 2015 were moved across to the 2015 scheme unless they were within 13 years and 5 months of their normal retirement date. So if members were paying in at that point and they had 10 years left from there to go to their normal retirement date, 10 years or less, they could remain in their original scheme, which would be the 98 or 95 scheme or 2008 scheme. If they had between 10 years and 13 years and 5 months to go until their normal retirement date, they would be moved across at some point on a staged process. This position has now been deemed legally to be discrimination. So this affects anyone who was a pension member in 2015 and has been moved across to the 2015 scheme and has paid contributions into the 2015 scheme since 1st of April 2015. It does not cover new members to the NHS pension scheme who have joined since April 2015. It will affect partners and employees. So there have been various consultations around this, and a decision has been reached that those members affected who have paid pension contributions between April 2015 and March 2022 will have the option at some point of moving those contributions back into their original pension scheme, so either the 95 or the 2008 scheme. However, there is no immediate panic to do anything about this because you will be given the option when you try to draw your pension of doing this or leaving the contributions as they have been paid at the moment. So there's no immediate rush, and the idea is that when you ask for a pension forecast, when you're approaching your retirement, you will be given different options. And there is no one rule, one size fits all. The position will depend on how long you've been in the pension scheme and what date you actually want to start drawing your pension. From April 2022 onwards, everyone will be paying into the 2015 scheme, so this position won't cause a problem from then onwards. So for some of you and for some of the partners at the practice, they will have to make a choice at some stage, but there's no immediate rush to do that. Just going to finish off now talking about pensions annual allowance. Now, if you're on this webinar as a practice manager or finance staff, it's unlikely you would have been personally affected by this, but it is likely that you will know GPs who have been affected by this, and in some instances they've had tax liabilities that have arisen running to tens of thousands of pounds. So that has caused a real problem. The historical position is that this has been in place for many years, and it affects GPs where the growth in their pension fund is more than £40,000 in any particular tax year, or potentially if their growth is more than £10,000 if they're a higher earner and they fall within something called the tapered rules. The difficulty with the pension growth is that it's not based on the actual pension contributions which are paid into the scheme, but it's actually based on historical pension contributions plus allowances for inflation and contributions which have been paid in during the year. So it's actually quite difficult to work out what a person's pension growth is. NHS pensions are meant to provide annual allowance statements to pension members if they have exceeded a growth figure of 40,000 per year. But often this hasn't been done, or it has been done late because NHS pensions have missed somebody, or they haven't actually had the pension certificate information through. So it is actually quite difficult to ascertain where somebody sits in terms of this. We have been recommending to all our clients that we think are affected by this for several years to get an annual allowance statement each year and request this from NHS pensions if it hasn't automatically been provided. Your GP partners should do this each year and send it on to us to check so that we can confirm whether there is a tax charge arising. If a tax charge does arise, then the GP has a couple of options. They can pay the tax liability to themselves. Often that will involve incurring interest because the annual allowance figures are not normally available by the time that any tax liability needs to be declared. Alternatively, they can ask to use something called the Scheme Pays facility. That is a facility available from NHS pensions where they will pay the tax charge on behalf of the pension member, but they will then treat that tax payment as a loan to the pension member, charge interest on it, and then adjust their final pension accordingly to claw that amount back. A number of our clients have used the Scheme Pays facility, and it certainly helps in terms of cash flow. But obviously there is an implication in terms of their final pension. There are also quite strict time deadlines for using the Scheme Pays facility. So GPs do need to make sure that they've requested use of Scheme Pays if they do want to use it before the deadlines. We have, however, had a number of clients who have submitted Scheme Pays applications after the deadlines, and those have been approved. So all is not lost if the deadline is missed. Because the annual allowance position was causing such a problem with generating additional tax charges, particularly for doctors, and there was a reluctance for doctors to work extra sessions to try and avoid the annual allowance charge, there have been numerous reviews and suggestions about what can be done to try and alleviate the pressure on doctors in particular. So there have been a couple of changes which have come through. So one of those changes relates to the 2019-20 year only. And for that year, if a tax charge arises, the government has agreed that people can use the Scheme Pays facility through NHS pensions, and they will then reimburse the pension scheme for that year only. So that would seem sensible for the 2019-20 year if anyone has an annual allowance charge to use the Scheme Pays facility, because actually it's not going to cost them anything. Now, we will be reviewing the 2019-20 position for all of our clients and have actually contacted some of them already. And we will liaise with our clients if we think they have an annual allowance charge and make sure that they have submitted the relevant Scheme Pays election. The deadline for submitting a Scheme Pays election for 2019-20 is the 31st of July 21. So there's not long to go until we get to that position. And for the 2019 year only, there will be a couple of extra forms which need to be submitted as well to claim for the compensation, which applies for that year only. So Lentils clients, we will sort that out for you. If there are practices listening who aren't Lentils clients, it would be worth your partners checking with their accountants to see if they have this in hand, as the 31st of July deadline is not very far away. For 2020-21 onwards, there has been a further adjustment. I mentioned earlier that some partners only have an annual allowance of £10,000 because they're higher earners and they're affected by the taper. So that taper threshold was originally set at 110,000 of taxable income. And if somebody earned above that, then they would be subject to the taper. Now, for a 7 or 8 session salaried partner or salaried GP, that's not a huge amount to be earning, and a number of our GPs were affected by that. The good news is that for 2021 onwards, the threshold at which the tapering starts has been increased significantly to £200,000. So that means that most of our clients will now fall below the £200,000 threshold, and most of them will now receive the full £40,000 annual allowance. That doesn't mean they won't still have a tax charge, but it means that they will have a lower tax charge, and more of our clients will be in a position where they don't have a tax charge at all. We will still continue to monitor that going forwards. So for clients that are affected, we will continue to nag them to get their annual allowance statements and to send them on to us. The downside of this is that actually for those highest earners who do have income over 200,000, the minimum annual allowance as part of the taper could reduce to as low as 4,000 instead of the previous 10,000 amount. I appreciate annual allowances are very complicated, so we are happy to discuss such issues with our clients, and we do regularly keep in contact with them to update them regarding what is happening.